Rally in IT stocks continues as Motilal Oswal upgrades the sector to an overweight rating, expecting stocks to benefit from the following: sustained underperformance and a shift from AI infra to application and service layers.
Food delivery companies Swiggy and Zomato open weak but recover after the new labour laws include gig worker under social security. Analysts expect the laws to have an impact of around 1 to 2 rupees per order.
NBCC surges nearly 4.5% after it bags an order worth nearly 117 crore rupees.
HAL trades under pressure after its light combat aircraft Tejas crashed in Dubai Air Show on Friday, making it the second Tejas crash in the last 20 months. The stock is down 3.5%. Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. Markets holding higher, as you can see to the top of the screen. The problem is the breadth of the market. You have that's under pressure. Only 1,000 stocks advancing, 1,600 stocks that are declining. That's what's not making portfolios feel too good, Mangalam. There is quite a bit of selling, and this green-looking screen, actually, the portfolios are not looking that green.
Take that point because, the large part of the up move is led by a couple of these names.
Yeah.
A lot of them from the IT pack, which has been an underperformer. But even from the banking pack, if you look at it, it's HDFC Bank, which is leading the Nifty bank right now. It's moved to the high point of trade and is supporting the cause of the frontline index. But by and large, HDFC Bank as a stock too, over the last few months or so, has been a mild underperformer. So let's take note of all those factors as well. HDFC Bank currently doing well. ICICI Bank giving it company as well. So let's see whether these heavyweights can take the market further higher from here on or not. But your point on broader markets, well taken. Let's get you some ideas for profit then. Coming in from our colleagues today, we have Money Control Pros Khushbu Rai Gupta joining in.
In today's idea for profit, we have Nestle India. The company saw significant growth in demand across categories led by key brands in urban India. Looking past the margin compression, the double-digit sales growth was a positive surprise amid GST-related inventory destocking in the September month. The festive demand product launch across key categories also supported growth in the quarter. While the noodles category delivered double-digit volume growth led by the key Maggi brand, in confectionery, the KitKat remained a key volume growth driver. These flagship products continued to gain market share, led by rising contribution of quick commerce, distribution expansion in the rural India, and also higher spends. Going forward, the GST rate cut in across 85 to 90% of the portfolio will drive consumption and contribute to overall growth. Hence, we believe Nestle is a good play in the packaged food segment and will be a key beneficiary of the urban demand revival.
Thanks a lot for that, Khushbu. Well, a quick reminder for all our viewers then. HSBC presents Future Female Forward Season 3, co-presented by Cognizant. From New Delhi, we bring you the newest state chapter edition with powerful perspectives, action-focused agendas, and a collective vision for accelerated equity. Tune in on 25th of November, that's Tuesday, at 5:30 p.m. onwards for insightful conversations only on CNBC-TV18 and CNBC-TV18.com. Well, time to slip into a short break. Come back, continue to focus on markets and stock-specific action. Stay tuned.
Welcome back. You're watching us here on Chartbusters. Now, as promised, let's get to the management of Billion Brains Garage Ventures, or you better know it as Grow. Ishan Bansal, who's the co-founder and CFO of the company, joins us now to discuss their second quarter numbers. Ishan, congratulations on listing the first quarter numbers that have come by as well. And alongside that, the detailed presentation that you guys have given to the exchanges, along with a Zoom call where the entire management was present. So kudos on transparency and investor trust. But now on to the questions when it comes to growth plans for Grow from here on as well. Let's talk about one of the businesses that has been doing extremely well for you. That's MTF. The book's grown from what? Almost, 389 crores in the second quarter last year, all the way up to 1,700 crores right now. That quantum jump that has taken place, do you believe that the best of growth is ahead of you? And how big do you expect this opportunity to be for you?
Thank you, Prashant, for having me here. And I think thanks for uh, looking at us from a transparency perspective. We actually want to be as much transparent to the public as possible. Our focus on MTF has been started like a year back only. So when we look at a number from a 300 crores at a Q2 last year level, that is the time when we just started. So it was like only a quarter in. So effectively, we've been adding roughly 400 to 600 crores every quarter to our book on MTF side. I think that is what has been continuing from last 12 to 15 months. And we think it is still a early stage for MTF as a product. It is only used by around 80,000 odd customers. And we think there is still a potential of at least, if not more, at least 5% odd customers should start using it over a period of time. But MTF as a product takes some time to build up because it's a balance sheet kind of a product. So everyone doesn't need it every day. But sometimes over a period of time, people keep on using it and then they kind of redeem, or not redeem in this case, but you can say square off their positions as well. But as the more and more people start using it, the book keeps on expanding. So we expect that book will keep on expanding in the coming future as well. If you look at overall market, there is more than 1 lakh crores of book in the market, and we are just 1%, 1.5% of this market today. And we think in longer run, we can reach a double-digit number.
All right. Hi, Ishan. Welcome to the show. Mangalam asked you the first question, and Nigel is here. We're happy to have you on the show, and we look forward to interacting with you earlier as well. Prashant and myself had interacted with you earlier when you all opened up the IPO. That said, let's move on then. Let's get a couple of numbers out of the way. For the first half of the year, there's been a bit of a degrowth on revenues. But I think the street was penciling, I think you all have briefly mentioned that there'll be mid-20% growth is what you're looking at in terms of revenues. You can correct me on that. Is that a number that you all would like to go by? And also, since you were talking about the MTF book, broking is dynamic part of your revenues, right? Majority of it comes from there. How do you see this evolve? As MTF and other smaller divisions contribute more, the dependence on derivatives volumes actually go down. So how do you see this contribution shape up? Growth as well as the revenue mix.
Got it. So I think when we talked about 20 to 30% kind of a growth rate, that was we are talking about from a longer term perspective. And our journey, especially because we are somewhere a capital market related business, there is going to be like a relatively ups and downs depending on the markets. And we obviously every year will not look the same. Hence, on an average basis is what we are thinking that we will probably end up doing 20 to 30% in a longer run basis. On the kind of change in pattern, we have already seen derivatives as a business, as a contribution of derivatives as a business has come off. Earlier it was in late 60s, now it is in late 50s. I think it will come off even further as our MTF and the newer business starts contributing more, because the growth rate of those businesses is significantly higher. And hence, in longer run, we expect all the businesses will start contributing significant revenue, and broking overall will probably be more closer to, like, say, 50-60% compared to only the derivatives piece doing 50-60%. Cash as a business is also growing because the MTF also gives benefit to the cash as a business, because the brokerage component of MTF will be counted under the cash or stocks as a revenue for us.
Right. I'm looking at your product portfolio where the first touch point of the consumers happens with Grow. Understandably, when you started out, it was stocks, derivatives, IPOs, MF lump sums, etc. But as the markets are maturing, the cult of equity is growing. We've seen a large part of your new customers first interact with Grow via SIPs. So this number, same time last year, was 29%, and it's inched up to 36% as well. What is your plan on monetizing this, and how do you translate this first touch via SIPs into revenue for yourself?
So the way we look at is we are a platform, and if customer comes from any of these products, we get their mind share, their kind of investments on grow. And over a period of time, most of these customers end up doing a second or the third product. So in even on the mutual fund side, you can see that within a time frame of let's say 2 to 3 years, more than 50% customers start using a second product. Second product, most of them will be like stocks or in some cases derivatives or in some cases credit. But there is like a lot of customers who need both of these products. And on a overall India basis also, if you look at it, roughly 50 more than 50% customers will be common between mutual funds and stocks. SIP as a product is very beautiful from a customer's kind of wealth creation
Yes.
perspective, because it helps them keep on adding money in both ups and downs of the market and generate more stable returns in a longer run. And it creates a positive loop for the customer in on the platform as well.
Right. And how does that impact your customer acquisition cost over a longer period of time? Because one is sticky, and then secondly, because of your platform approach, people start using other products as much. So ideally, that should lower your CAC, right? How has that moved? And it should also increase the lifetime value of a customer because of your newer offerings. So this CAC to LTV sort of ratio, how does that change from what it was to now and what it could look like going forward?
So LTV actually has been slightly difficult for us to calculate because we've been launching newer and newer products. But what we look at is on a short-term basis is a payback period. And our generally the target is the payback period should be somewhere between 4 months to 6 months. And today we are more closer to 6 months because market has not been very good in last 1 year, and hence the acquisition has been relatively more expensive. And CAC, if you look at, we look at CAC on a blended level because it's very difficult for us to message exactly that a customer A will start with SIP or will start with stocks. But what we message to the customer is if they want to start investing, probably Grow is one of the best platform for them to start investing. And we have multiple products available for them, and they can start with whatever they are comfortable with.
Okay, all right. Ishan, final couple of questions before we let you go. You know, the investor base moving up is going to be important. And that base actually has reduced. What are the targeted numbers there? For example, how long will you take to maybe double this customer base that you have right now, investor base that you have? A rough projection out there. And as you said, on a longer term, we're looking at 25% revenue growth. But in the near term, for this year, what should the street work with in terms of growth, given that the first half of the year, you have a degrowth of around 10%? So give us clarity on both these two fronts, this year's guidance, as well as in terms of the customer base.
So on the customer base, idea is that there will be like, again, when market cycles are negative, the growth actually takes a hit. But in that market also, if you look at it, with the exception of this last quarter, our NSE active number has been growing, but active number on the platform was still growing, but it was growing with the lesser pace. So YOY 20% growth is still there when we are looking at a bad markets. So we think this 20% growth rate we can maintain in bad markets and can be easily be beaten in the good markets as well. So assuming if the market continue in a similar way, we will be more closer to 15 to 20% kind of a user growth. Coming back to
FY26.
This year's numbers. So I think first 2 quarters was slightly different because the regulations that came in, there were two regulations that primarily came in. One was regarding the derivative side and another was regarding the true to label side. Both of them started happening from October timeframe. And what we see is that without these regulations, we've been doing well. And in the coming quarters, you will start seeing the growth also from a YOY basis, from a revenue perspective. But it'll be very difficult for me to come to a number saying that how much will be a blended number coming between both of these with regulation and the without regulation kind of a time frame.
So on a year-on-year basis, by the end of this year, when we speak at the start of the new financial year, would you have had positive revenue growth in FY26 versus FY25?
Our expectation is that, yes, this will be positive.
All right. And just throwing this one at you, Ishan, with a lot of studies that suggest most of the traders are making losses, 80, 90%. You observe the same?
So in our case, it's slightly different, but what we have seen is that derivatives as a product is very small on our platform from a number of users only doing derivatives. So there is around 0.3% customers who only do derivatives. And in that cohort, this number is similar. But our expectation is that people end up doing multiple products. And hence, if they are losing money in one product, but they are still making money on the other product, overall, still they are growing their wealth.
What's the average return per grow customer on a year-on-year basis? Have you done this calculation?
So that number is very variable, obviously, because again, it's linked
It's a
with
function
the.
of the market, yes.
But people have generated, I think there was a time frame when we looked at this, I think around 60 to 70,000 crores was generated on Grow as a platform. And I'm sure this number would have increased further in the recent times. I think this number is something a year old or so.
Okay. All right, Ishan. We'll try to get you further clarity, but appreciate you joining in. Wishing you as well as the team all the best, in the time to come. And we look forward to chatting up with you soon. Have a good day ahead. Well, time to slip in a short break, but as we do that, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of that at your fingertips. Download the CNBC-TV18 app from the Apple Store or from the Google Play Store. Or you can just scan the QR code that's come up for you on the screen. Welcome back. You're watching Chartbusters here on CNBC-TV18. Well, as promised, let's get you a technical check. We have Dharmesh Shah of ICICI Securities who joins us on the show. Hi, Dharmesh. Good morning. Good to speak to you. It's been a while since we chatted. Well, tell us, how do you view the Nifty? What's the call out there, levels you're tracking, and fill us in with your individual calls.
So good morning, Nigel. Yes, definitely. I think so. There is a lot of tough war happening between bulls and bears at the psychological level of 26,000, 26,200. But what we believe, I think so, the way the technical setup seems to be forming for the Nifty, it looks like I think it's a question of time. We should take out the lifetime high and we should be looking for a target of around 26,500 for as far as Nifty is concerned. If you look at the relative outperformance for last 2 weeks, I think so something key point to highlight is that the Nifty has been outperforming by 3.5%, whereas if you look at the global markets like Dow Jones or even European markets, they are down by 5%. So in terms of relative outperformance, yes, definitely Nifty is showing the signs of relative outperformance, but some bit of a selling pressure in the small cap seems to be disturbing the party. But we believe, I think so, the way the technical setup for small cap also, it looks like I think so it is at the very strong support of 200-day EMA. So we believe we can see some bit of a stability in the small cap also from the current levels. But as far as Nifty is concerned, we expect Nifty to head towards 26,500 with strong support placed at 25,600. So yeah, buy the dip should be the strategy going forward. As far as Bank Nifty is concerned, yes, definitely Bank Nifty has been the leader even the current today's trading session. We expect Bank Nifty to head towards 60,000 in the coming few days. So buy the dip should be the strategy going forward.
All right, buy the dip should be the strategy. And any particular stocks, Dharmesh, that you'd like our viewers to take note of?
We remain to be positive for the Bank Nifty as so PSU banks looks more positive from the current levels. As you look at the PSU index, I think so it seems to be coming out of a 16 months of long consolidation breakout, which augurs well for the uptrend going forward. So we believe Union Bank among the PSU banks looks positive. Again, the stock is forming a cup and handle formation, and the way the technical setup seems to be forming for Union Bank looks for a target of around 168, giving a stop loss of 138. So Union Bank remains to be a top pick inside the banking space. Apart from Union Bank, logistics space looks positive, and where again we remain to be positive for Adani Port. Adani Port, the stock has also witnessed a breakout from the cup and handle. For last 6 quarters, the stock has been consolidating this range of 1,000 to 1,500. We expect a breakout to happen above 1,500 and look for a target of around 1,675, keeping a stop loss of 1,375.
Okay, all right, Dharmesh, quick word on the metal index. When things were looking good, very bullish calls are coming in on the index itself. Now, the globe has gone into a bit of a near-term tizzy, a bit of risk-off prevailing, Bitcoin slumping, some softness in terms of global metal prices. And also you have the Fed that may or may not cut rates. Any view on the index?
Yes, Nigel, if you look at the metal index from the medium-term perspective, what we see is nothing but a retracement happening of a sharp move in the metal index. And also the dollar index also is something which is disturbing the metal party currently. But what we believe for metal index, I think so, it seems to be forming a strong support at around 9600, 9700, which was the previous breakout level. So yes, metal index, we are not negative. Yeah, in the near term, we can see some bit of a profit booking happening for the metal space as a whole. But from the medium-term perspective, I think so any fall or any dip in the metal stocks like Tata Steel or even SAIL should be looked as a buying opportunity.
All right, we take that point. Just before we let you go, here's a curveball. Do you have a view on the IT space?
Yeah, IT again, I think so. Lots of, I think so, depend on the US market. But the way the technical setup seems to be forming for the IT space for Indian market, it looks like worst seems to be getting over for overall IT space as a whole. We believe the stocks like TCS, Wipro, HCL Tech are the ones one should definitely look out from the medium-term perspective. So we are not so negative for the IT, but yeah, definitely it's more of a stock specific rightly going on in IT space.
All right. Dharmesh, thank you so much for joining in and giving us your view on a whole host of stocks, and the index buy on dips should continue. With that, what we'll do is take your leave on this edition of Chartbusters with the promise that the team of Trading Hour comes up next. All four indices in the green, not so much the broader markets in terms of market breadth, but let's see how that pans out. From Nigel and me, the entire team, thank you.